To you first. You're going to tell us about ITC, the big index heavyweight. Have you been smoking enough, and what do we expect?
No, Nigel. First up, I'm a teetotaler. Secondly, I do not advise smoking. But talking about ITC, first things first, it is a consensus buy. Out of the 20 brokerages I polled, almost 17, 18 had a buy rating on the stock, and the street has a lot of expectations from this number. For ITC, with all the hullabaloo around there, FMCG, hotels, and other businesses, it's still cigarettes which contributes 90% to the operating income and almost two-thirds to the revenue. So the key thing to be watched will be cigarette volume growth. Our poll throws up a range between 2 to 4% as far as cigarette volume growth is concerned. Anything above 2.5 to 3% will be considered as a good set as far as cigarette volumes are concerned for ITC, because if you look at the trend, over the last 10 quarters, it has been in the negative terrain. Last quarter was a bit flattish, so we expect the momentum to continue and positive growth. So the factors that would lead cigarette volume growth, the first one, it's got a favorable base going for itself. The base quarter saw a decline of almost 17% as far as volumes are concerned. Secondly, the product mix will shift towards the sub 65 mm cigarette, because the company has been cutting down the length of its cigarettes to cater or to make sense of the excise duty, to benefit from that rather. And secondly, the last quarter saw a bit of bottoming out of cigarette volume growth, because after 10 quarters of consecutive decline, the last quarter saw a flattish volume growth. So the momentum, as the street expects, is likely to continue. But the naysayers have their reasons as well. They believe that ITC, remember, had shut their factories for 15 days during this quarter for over confusion over the pictorial warning. So that could amount to about 100 basis points as far as the volumes are concerned. Nevertheless, 2 to 4% is the range to keep an eye out on. Other than that, our poll expects a top-line growth of 10%, around that 9,400 crore mark. EBITDA margins around that 38.9% mark, slightly below what we saw in the comparable quarter, and the net profit growth of 10%. If I must, three numbers to remember: 9,500 on the top line, 6,500 as far as cigarette revenues are concerned, and 2,500 as far as net profit is concerned. But remember one thing: the numbers may look different because of Ind AS reporting, because ITC revenues will look higher on account of inclusion of excise duty, and ITC accounts for about, or the top line accounts for about 28 to 30% on excise duty. So that could be the change that we would see on the revenue. Margins will look optically lower because the revenue is looking higher. And thirdly, the EPS, employee expectations, or rather the employee expenses, will be treated as fair value as far as ESOPs are concerned. So Credit Suisse believes that could have a 5 to 6% impact on the EPS. So the numbers may look lower. Key number to watch out for will be cigarette volumes.
Okay, thank